Welcome back to the channel. Today, we're going to be looking at technical indicators and asking the question, can they really predict the stock market? We've got academic papers, tons of research, all that good stuff. And, some of it really praises these indicators, but then other research just completely slams them.
Yeah, it's a really interesting debate because when you think about it, technical analysis challenges that whole efficient market hypothesis, that idea that past price data can't really predict the future.
It's like saying, hey, there's a code in these charts, and if we figure it out, we've found the key to making money. But then you have the whole other side saying it's basically just voodoo.
Right, exactly. And even in academia, people are still arguing about whether technical analysis actually has any merit or not. But before we can even really have this debate, we need to define what we're talking about here. So when we say technical analysis, we're talking about looking at historical market data, things like price and volume, to try to figure out where prices are going next.
Okay, so it's all about those charts, the trends, all those lines going up and down. How is that different from something like fundamental analysis, where you're digging into a company's financials?
Well, with fundamental analysis, you're trying to figure out a company's actual worth based on its earnings, assets, things like that. Technical analysts are more interested in the price action itself, those patterns that might show up over and over again, and they use technical indicators to try and spot those patterns.
Got it. So indicators are like the tools they use. I've heard of some of them. Moving averages, MED, RSI, Bollinger Bands. It feels like a whole different language.
It can be a lot to take in for sure. Every indicator has its own way of being calculated and interpreted, but they all basically take that price and volume data and turn it into signals, hopefully signals that tell you when to buy or sell. Take moving averages, for example. They smooth out all those little price jumps to show you the bigger trend, like seeing the forest instead of just the trees.
So you don't get caught up in every little price change. You see the overall direction of the stock. Makes sense. But the real question is, do these things actually work? Can you actually make money using them?
And that's the million-dollar question. Some research shows that they can be profitable, especially in emerging markets. There was a study on markets like India and Russia that found that certain assets consistently did better than just holding on to an investment when using specific combinations of indicators.
So in those less developed markets, maybe there's more room for technical analysis to be effective. What about more developed markets, though?
Well, there's research that throws some cold water on that idea. Some studies show that these indicators don't have much predictive power. They even suggest that some common ones don't actually work the way people think they do. One paper found that a couple of indicators often used by traders weren't nearly as effective as they were expecting them to be.
So maybe the markets have caught on to these indicators and adapted, like a game of cat and mouse between the traders and the market itself.
That's one theory. As markets become more efficient, information travels faster, and those historical patterns might not be as reliable anymore. That could explain why indicators that used to make money don't work as well now, especially in those well-established markets.
Okay, so it's not a foolproof way to make money. You can't just choose any indicator and expect to get rich. There has to be more to it than that, right?
Absolutely.
Mm.
Using a default settings probably isn't going to get you very far. Successful technical analysis is about customizing those indicators to the specific market you're trading in, the time frame you're looking at, your own risk tolerance, and even your personal trading style.
So it's like tailoring a suit, making sure it fits you perfectly and is right for the occasion. So customization is key. But even then, is it smart to rely on just one indicator?
Yeah, you're absolutely right. Most experienced traders don't just use one indicator. They'll use a bunch of them together to double-check the signals, get rid of false alarms, and make better decisions. It's like getting a second opinion, or even a third, before you do something big.
I see. So they're looking for that extra confirmation. We talked about emerging markets being good for technical analysis. Was there any specific research on that?
There was a really interesting study on those BRICS countries, Brazil, Russia, India, China, South Africa. They looked at how profitable moving average strategies were. They put together a bunch of assets from those markets and basically made fake trades using a system based on those moving averages.
Oh, so they took out the human element, just let the system run on those indicators. How did it go?
The results were pretty impressive, actually. On average, the returns from the system were more than what they initially invested. So it suggests that, at least in these emerging markets, there's some potential for profit with technical analysis. But there's a bit of a catch, of course.
There's always a catch. What is it this time?
Well, it wasn't just any random assets that were doing well. Certain groups within each country consistently outperformed the others, and these usually turned out to be assets from companies that were considered dynamically capitalized.
Dynamically capitalized. Not sure I've heard that one before. What does that mean?
Think of companies with a lot of potential for growth, the kind that can really take off in the market. They might be new companies, really innovative companies, or companies in industries that are growing super fast. They're the ones that attract a lot of attention and trading activity.
So even in a market that's generally good for technical analysis, it still matters which stocks you pick. You want the ones with that extra something. Is that where fundamental analysis comes in, to help you find those dynamic companies?
Yeah, that's one way to think about it. You can use fundamental analysis to narrow down your choices to those companies with high growth potential, and then use technical analysis to figure out the best times to buy and sell to try and ride that wave of momentum.
So it's not about choosing one or the other. You're saying technical and fundamental analysis can work together.
Exactly. It's like using two different lenses to look at the market. Each one shows you different information, and when you put them together, you get a much more complete picture.
All right, so we've seen that indicators can make you money, at least sometimes.
Yeah.
What about the other side of the argument, though? The research that's not so sure about technical analysis. What do they say?
Well, some studies have looked at these broader market indicators, things like the advanced decline line, short sales volume, and volatility indices. They're trying to capture the overall feeling and strength of the market.
So not just individual stocks, but trying to figure out the mood of the whole market.
Exactly. The researchers wanted to see if these indicators could actually predict what the S&P 500 would do. They used a massive amount of market data going back decades to analyze those relationships.
Did they find anything, like a crystal ball hidden in those market indicators?
Well, not really. The results were kind of mixed. They did find some indicators that had a real connection with market returns, but the overall picture wasn't very clear. Some of those classic contrarian indicators, like the short interest ratio, which some people believe can signal a market reversal, didn't actually behave the way they were supposed to.
So instead of showing a change in the market, they were actually confirming the current trend. That's pretty interesting. What could explain that?
Maybe investor behavior is changing and those old rules don't apply anymore. Or maybe the market's just gotten more complex, harder to predict with these old methods.
Like the market is evolving, learning from our attempts to understand it, and adapting along the way.
It's a pretty fascinating thought, right? It makes you wonder if the indicators need to evolve too. Could there be a new kind of indicator that takes all this complexity into account?
So indicators that are more dynamic, more responsive to all the changes happening in the market. Makes you think about what the future holds for technical analysis.
Yeah, it's a pretty exciting area to think about. Who knows, maybe we'll see indicators that use AI and machine learning, algorithms that can look at mountains of data and find those tiny patterns that humans miss.
So instead of just looking at old numbers, these new indicators would adapt in real time, constantly learning and changing as the market changes, like having a superpowered trading partner who can see things you can't.
That's a pretty cool vision for the future of technical analysis, for sure. It kind of brings us back to that first question we had. Do these indicators actually work? And like we've seen, there isn't one simple answer. It depends on the specific indicator you're using, the market you're trading in, your strategy, and a whole bunch of other factors.
It's not some magic solution, that's for sure. But it seems like technical analysis can be helpful, a way to get ahead in the market, especially when you use it with other things, like fundamental analysis.
Absolutely. Whether you've been trading for years or you're just getting started, understanding how technical analysis works can help you make smarter decisions. And as the market keeps evolving, so will all the tools and techniques we use to navigate it.
So, for everyone listening, what stuck out to you? What made you curious? Here's something to think about. If those traditional indicators are becoming less reliable in these efficient markets, could those new indicators, the ones that can keep up with all the changes, be the key to success? The search for patterns in the market never really ends. Who knows what we might discover next? That wraps up our look at the world of technical indicators. Happy investing, and maybe try experimenting with some indicators if you're feeling adventurous.